So we're going to get started here, making how to make money, or I guess where to find the money. So mainly talking about hard money lenders, and I mean, we would like to break it out into 3 parts, I guess, this talk. One would be Q&A.
Maybe you should get in front so they can see you.
One would be Q&A. 2 would be the market and how it's doing, DC compared to the DC metro market. And then the third is the topic, hard money lending, where to find money, how to syndicate money, how to ask friends and family for money. Unfortunately, I think Damien is still on. Hopefully, he stuck around. I'll text him. He syndicates money. Lee Johnson got COVID, so he's not able to join us. And he syndicates apartments from 100 units to 300 units, and you could invest with him. He's you just need to have $50,000, and you could he forms REITs. So unfortunately, he couldn't come today.
Take that, please.
Yeah.
I'll just take the whole file, so you can just talk.
Okay.
I think this is worth sharing really quickly. Talking about money. A picture's worth 1,000 words. I don't know if you have this in a way that you can share it to the group.
Yeah, I can pull it up.
Okay, but really quickly, we do like to look at data, and we were looking at this as a team today, which is it's just a snapshot of how the Fed has been doing in the recent past in getting inflation under control. Some of us, like just now, I was commiserating with Mike over here, who, like I said, also is in sales, saying that, you know, I've been busier with regard to sales, and you know, part of the difficulty in this current market for us practitioners who sell. Did you happen to load the image up too?
Yes, I did.
Oh, great. I can't tell what they can see. But if you look at this chart that Nick's just loaded onto the screen, basically this takes a look at since late last fall, what the rate of inflation has been, and you can see, you know, it starts off over 9%, over 8 or 9% in this picture, and it's a steady decline. It looks like the Fed's work has been paying off, and then what you do see, however, is a little bit of an incline again that comes this summer. So late June, early July, what you see is that it's moving back up again. I think Vegas and Wall Street are betting that tomorrow the Fed will not raise its benchmark rate, and we'll wait. We'll take a wait and see approach, but that's not a unanimous view. I'd say it's a majority view, and the reason it's not a complete unanimous view is because of that little tail there after late June or July, where you see it start to move back in the wrong direction. That's inflation moving up. However, it's you know, it's under 3.7% right now. I think some major contributing factors that we're hearing about in the media to this little uptick come late June, early July are gasoline and actually rents, what they call shelter inflation. So as you probably know, when the Fed looks at the various costs that go into calculating inflation, welcome, how you doing? They don't actually look at resale, Carlos, nice to see you. They don't actually look at resale data, but they look at rental data, and that's what they call shelter, the cost of shelter. And we've been seeing some shelter inflation, which is great for us buy and hold folks. It's really, I think, in great part, people on the fence who could buy or rent, choosing to rent instead, placing upward pressure on rents, a little bit of downward pressure, certainly diminishment in demand. So I just thought I would call this one out, just because I love it when a picture can do better than words can. And I know I use many too many words. The picture speaks for itself.
Yeah, and I think that's interesting because, you know, they've predicted that in September that it was supposed to be 0%, that they were going to start decreasing
Their rate.
interest rates.
Can I ask a question?
What are you talking?
So do you, as a practitioner, are you actually in a market like ours where there's low inventory? How are you looking at all these indicators when you're making decisions? Because certainly from a velocity standpoint, we have no inventory, so we still are seeing lots of sales. We're seeing multiple offers. We're seeing houses below $1.5 million or deals that work. Everything's still trading. So how how much of these national trends and indicators how much are they affecting markets like
DC.
Shaw, Eckington, Capitol Hill, or are they at all in your
I think about
given
that.
your experience?
I think about that from two perspectives, Mike. One is I own real estate,
Yeah,
and I'm really grateful that it's not like you're saying, it's not crashing,
right.
it's not losing a lot of value. It's maybe a little. I think most of the properties I own, I probably missed my high point to sell. Meaning, I think right now for most of them, I might sell for a little less than I might have, maybe early last year. But I own in DC, and DC is a little bit down. If you had a house in Bethesda or Silver Spring or Hyattsville or anywhere, Akakeek for that matter, I think that you're probably feeling pretty good about that you may be at the high point right now. I'm mostly a city realtor and I'm mostly a city investor. So as an investor, I feel pretty good because my values have held pretty firm. And I'm not planning on selling anyhow. So I just want to make sure that's okay. And like I was saying earlier, rents have risen. So I feel good about that.
Yeah.
As a realtor, it's a little bit harder because there's fewer transactions. So even though the tension's there on pricing, just the volume is down. And that's how you and I make a living. And so that's been bumming me out. And for that reason, I've been praying to the inflation gods that they would give us a break so that the Fed could relent, so that markets could shift. And one interesting thing that we've been looking at on our team is that apparently National Association of Realtors is saying that, because like part of the problem with inflation is it causes rates to go up so much, and that really diminished demand. But it's also diminished supply because there's a lot of people locked in at 3-4%.
They're not moving.
Who don't want to move. I mean, they want another bedroom, but they're like, but if I got to go from 3.25 to 7.5, you know what? Maybe I don't need another bedroom that badly.
Yeah.
The boys can sleep together another 2 years. Older guy's only 11. He's not in puberty yet anyhow. Whatever they got to say to themselves to sort of delay that move that they feel that they got to make.
They want to downsize, but they're going to not pay the same amount.
Totally, 100%.
So they're not going to move.
100%. So they're not going to move.
Which means
So
inventory is not going to increase.
exactly. Yeah. So it actually beats up both supply and demand, both demand, which we know, and supply. But the thing about supply, the NAR did a study, and apparently they think that if the rate can get down, the commonly found, plain vanilla 30-year mortgage rate can get down to like 5.5%, that will unlock a lot of sellers. It won't be maybe the 3.5 or the 4 you've got, but it's close enough. It's striking distance. You do want that additional bedroom, or maybe you want to get rid of that additional bedroom if you're on your way downsizing. And now you're like, I think I can do this. So that's what their surveys are telling them. They don't know that for sure. And
unlock the buyers too. So.
then it could unlock the buyers, which would be great. And then both demand and supply would be up. And then that would be great certainly for us as owners, as realtors, big time.
Yeah.
I think as investors, maybe it gives you sort of the courage to go out there and strike. I do think that some savvy investors are buying now, but they're probably very well capitalized, right? I was just talking to a big time developer who's looking at a 48 unit project, not with me. Unfortunately, I wish. He's a developer friend. And he was telling me that on another project he's got, the equity requirements gone up, because they're like, the reason we're telling you this is because now we're running your numbers on 6.5, 7.5. And at those numbers, we don't like the way it looks. And so we want more equity in. So he's like, wait, my rate's going up and I gotta try it, so that they're calling his loan basically. And so now reluctantly, he may have to bring in an equity partner or two, or some mezzanine level financing partners. It's complicated. It's hard. But we wanted to ask you, Mike, what tell us, first of all, you're allowed to like shop your wares in this group. Tell us who you are and what you can offer. And in particular, with regard to money, I'm fascinated, what you know and what.
Well, as you know, I'm primarily a real estate agent practicing in the region. And I work with a lot of urban infill developers, investors, 2 units to like 25, 30, ideally condo, but now more market rate, less voucher. But that's what I do from a transactional standpoint, from a real estate standpoint. But what I also do is perform kind of an advisory service as it relates to the debt and equity component. So as you just illustrated, many of the local banks are requiring their legacy developers to come to the table with a little bit more equity because of the rates, obviously. So, and the requirements to have more deposits and better reserves and et cetera. So we help certain clients bridge that equity gap, which we see a lot more in the kind of 20 to 50 unit realm. So if a guy's getting it, it's really all a matter of how good are you getting the deal. So if the deal works, if the deal works in this environment, if the deal works in like a 6.5% environment with construction costs now, it's going to work. It would have worked really well a couple of years ago.
Yeah.
If the deals that people were looking at or trying to entitle over the last, at the end of COVID up until about 6 or 8 months ago, those are a little bit marginal. Those are really, really hard to make work now from a takeout standpoint. So we're kind of in a unique space when I say urban infill, that's kind of like everything in DC, close in Hyattsville, Mount Rainier, North, South Arlington, development sites. So these are either land deals, existing deals where operators may have higher than normal hard money and they haven't exited the deal. They're kind of 6 or 8 months on in construction. So now a lot of those deals are kind of lagging and they need to get out of those deals. So we kind of put new people in those deals and then help them bridge their equity requirement, which everyone's gonna need. So there are lots of I'm seeing a lot of opportunity. Many of the sellers and their commercial brokers or their seller representatives haven't yet. I think overall the market needs to take like a 25% adjustment, and then a lot of that stuff can transact, but they still aren't ready to go to that number.
In terms of, the prices of development projects that you're seeing?
In terms of whether it's funeral home, whether it's development gone bad, whether it's a development that's about to go bad, whether it's a deal Forbright or Capital or Industrial has that they want to kind of bring someone in to take over. So the smart operators are having discussions with their lenders, real discussions. Here's where we are. We're current, but we want to transition out. So we're having conversations with bankers about who to bring into those deals. But again, either the developer is going to take a haircut or their lender is going to take a haircut, or both. But for the right deals, they can still not lose money and give all their friends and family back their principal. If they wait too long and these community bankers continue to ask for these equity components, the carry just continues. The longer it sits, the less likely the friends and family, literally friends and family, the uncles, the grandmothers, the trusts, the less likely they're getting their principal back. Mm-hmm. So it's kind of like what do you call it, chicken? Like everyone's kind of
who's going to go first.
Yeah. Mm-hmm. And those are very, unfortunately, I like to transact on houses and condos, but most of my day is back and forth, back and forth, back and forth. These are long time negotiations, all the way up until, if you notice that, I don't know if you guys look at Alex Cooper, you're going to start to see a little bit more VC opportunities.
Yes.
That's just lag from COVID. You'll see more and more deals, and we went 2 years, you can see anything announced.
No.
I can't remember what neighborhood it was, but today I saw, it might have been like a Columbia Heights,
Columbia Heights,
a renovated, like $1 million+ type property on Alex Cooper, fee simple, for $500K, staged and everything. I didn't understand what I was looking at. I don't know if maybe they're just trying to create a crazy bidding war.
Well, a little bit of both, but those are real. Those are delinquent. That's the bank. That's Genesis Capital. That's WFP. That's Templeview. That's whomever calling. So you can see those
show up
all the way through May, June, July, and then hopefully, this is just the market, just this part of the market.
And for people that are listening, WFP is Washington
WCP. I said WCP. Sorry.
Prime Properties.
Yeah,
Washington
company.
Capital Partners, Genesis, these are all hard money lenders that
Large ones.
have extended a lot of liquidity, and now liquidity is drying up because they're not selling. When you don't sell, they don't get repayment, and when you don't get repayment, you're not able to. So there's a holdup. There's a bottleneck in the liquidity. How it was running so fast when it was 2%, but now it's so slow.
Right. So there is real opportunity now in this market. It's really dependent on who's on the seller side from a broker standpoint, and who's on the buyer side, and if they can make an agreement. So we're seeing opportunities, and I've got clients, and I'm in the market looking for stuff, and that's what we're doing, negotiating all day long. We're looking at deals. Oh,
And who's got this money that you bring in at the mezzanine level to help a developer?
Could you explain that mezzanine?
Well, I'll let Mike explain it.
Well-
So let's say I'm a developer, Nick's the bank. He wants to sort of reposition what we've got, our arrangement. He wants more equity and the rate's adjusting. And I'm like, I'm crying uncle, I don't have that much cash. I go to you.
right.
I don't need names, of course. I'm just like, what's the profile of the people you're talking to?
In the ideal scenario, before you're acquiring the asset, we have one source where you borrow both the equity and debt. One same source, literally same, for lack of a better word, bank. And they're a small group. They're specific. They're fun. They went out and raised money, and they know that the equity is what's most needed in markets like ours. So that's what they're providing. So it's really all deal dependent. Probably 30 million available today for the right deal. Most importantly, the right operator.
Yeah.
Which there are plenty of.
Sure.
And the money, ultimately, the money is coming from, I don't like the word angel investor, but these are, family offices, high net worth individuals who were, many of them were funding a lot of the ultra expensive properties out in Great Falls and McLean, the $2 to $15, $20 million deals, individual single families. A lot of
the flips of those.
yeah, a lot of those original investors are now looking for faster returns. Like they put in $3 million on a single family deal. It takes 2 years to build, or it takes 3 years. It takes forever to sell. Those people. So one tranche is from local. They're like groups of doctors and lawyers, and dentists.
Mhm.
U.S. based another, who basically have put together small funds, small, just pools of money. They were investing with their friends out in McLean and Great Falls, and kind of did well, but now they're looking at a quicker way to churn some of the money from their practices. That's one source where we help place that, both debt and equity, or right now, particularly that source is equity. And then the other one is a bank. Was a former Wells Fargo guy who really knows this market in and out. So they were in the hard money business. Now they're in the equity business.
Interesting.
But there's plenty of money available
For the right deal and the right operator.
and the equity likes our market because it's Washington. So
Yeah.
our rents are strong.
Yes.
As you know, our voucher program is strong,
Yep.
and our sales velocity is strong.
Yep.
We aren't seeing, these guys were operating in all the LA markets, New York markets, Williamsburg, Brooklyn, South Florida, but DC is a safe hedge against Wall Street. So it's a safe place. They can come, touch, and feel it.
Yeah.
If it's a 20 unit in Trinidad, even if it's market rate, they know that Trinidad's land value is never going to go down.
Yep.
They'll likely only get better. So ultimately, that 20 unit building will still be valuable in 5, 10, 15 years if it's an apartment.
Yeah.
Even if we've got guys now looking at condo executions, but we're underwriting them as apartment. So
Oh.
worst case scenario,
That's your backup. Is good
if
enough.
we're not giving you your money back in 2 years when we're selling condos,
Mhm.
here's what it looks like as a market rate. Do you still like the deal? Here's what it looks like as a voucher deal. Do you still like it? So those are the execution scenarios we're running literally on every deal.
Yeah.
But this is a very investment focused, especially our foreign buyers, UAE and other parts of the world. They love owning real estate in DC, which is why they're investing in these big houses in Great Falls.
Right.
But they aren't really getting a good return on those because it takes so long.
Yeah.
To get your principal and you're getting like a 15-20% return
Over 5
over
years.
4 years. Like you could put that in the,
Sure.
like that's not a good,
Sure.
but they like it because it's a big, shiny, big, pretty house. But they take 2 years to sell, 2 years to build. Our projects, even though DC's takes long, we're still in and out of deals in 36 months mostly. So so that's why I'm, as you know, that's why I'm really optimistic, because in a 7% market, we can loan money, we can buy deals, we can help finance deals, we can sell deals, we can sell broken deals, we can sell foreclosure deals, we can sell short sale deals, every segment. Like I'm seeing all this stuff.
The opportunity
can
that
trans-
comes with the transition.
So we can transact 7% market now.
Mhm.
That's why I'm excited about the next 36 months, because
It
people
can
are
only
still
get
doing
better.
deals right now.
Right.
They're looking at deals over and over again. Well, what if we do it this way? Instead of doing, 70% twos, why don't we do 50% one and dens? And then here, like, people are really spending time. They're not vacating our market, going to like the Carolinas, doing townhouses, or going to Virginia Beach and doing, rentals with the Navy. They still are very bullish on our market. So that's why I'm
That's
excited.
interesting
We
to
just
hear.
can't break these deals loose.
But I also see that a lot of builders or rehabbing folks, like instead of doing like 10, 20 homes a month or a year, some of them, like, right? So they're just like working on quarter of their, really what they could do the last couple of years, like, right? So like some builders that were building 10 homes a year now are probably 2 or 3. Money is expensive and banks are difficult to get money from, right? So a lot of banks are really stepping on the brake or totally
Oh, for sure.
not lending.
Yeah.
So it just makes it
Which is
really
the other
difficult.
problem.
So like I
Big problem.
spoke to one gentleman actually has been doing business with one bank for 18 years, right? So and then he just calls me one day. It's like, hey, this guy is not lending me anymore. Like I've been working with this bank for 18 years. I have millions of dollars over there.
Yeah.
And this time they're not lending on me. So like they it's just not because of one client, but the whole bank has just stopped lending.
Yep.
And that's a difficult process for him. So he can't do 4 homes a year. Now he has to do 1 or 2 because he has to work with a new lender, maybe a private money or hard money guy. So instead of going 6-7%, right now he's looking at over 10% rate. Right? So his returns and everything works against him, right? So
What is that rate rates now?
I mean, depends on the lender. I don't know what WCP is at.
I would think it's somewhere between 9 and 11.
Yeah.
Depending on your,
Uh,
your project and your track record
yeah, I see also
and your
like,
equity.
yeah, you're right. And a lot of times,
That's
like,
what you're saying?
yeah, I see
9
that
to
too.
11.
Yeah, 9/11. Yeah, you don't really see, especially the hard money or private money, you don't really see anything less than 8.5. Banks also like pricing it prime plus, so it's
Yeah. And all of
So,
the,
yeah.
Capital Eagle,
So-
they all did the same thing. They all kind of
compared
slowed down.
to the banks, hard money is a lot easier to work with,
Yep.
faster to close, and all of those positiveness, them, they have to price it up too. So to that, so if you get 9% with hard money, probably it's a good deal at this market. I think it might be.
Yeah, sure.
Are you seeing a lot more defaults within the industry of developing because they have a pipeline of houses that can't sell, construction costs are too high, then they don't make a profit and aren't able to, what worked before is not working now. So they're having to be creative.
There'll be lots of, there'll be more, I call them broken deals.
Broken
You'll see a
deals,
lot
yeah.
more broken deals from traditional, there's still a backlog of people that have to be foreclosed on.
Yeah.
Then there are all the people where all the private groups All the people who've been loaning money in this town forever are all foreclosing on their people. So there's a backlog of,
Because it's a process.
yeah.
And also I think what I see is like, it is like going up, like those, bad deals are showing up, right? Banks books and everywhere, so, but at the same time, it's really, it's a time to shine for pros, like the pros are still doing great,
Yep.
they're still doing
That's a
deals,
good point. I
still,
know you believe that.
That's
because
the
there are
opportunity.
people who are doing on the side, like part-time, or, they have money, they just want to do it or cheap money they have. So they wanted to just flip homes because they see the next door is doing it, right? So those guys started to either, can't really put up any more money, right? So they have to stop on what they're doing and either foreclose or whatever they need to do, or they're not doing it anymore because they see money is not cheap anymore. They're like, you know what, I can park my money with the treasury at 5.5% or at the bank at 5%, instead of really doing this and lose money. Who knows what's going to happen or whatever, right? So that's really, those guys scaling back or just going to the side, and stop doing the deal. And the pros, they know what to do, like they know like their returns.
If
They
you
need
can
to hit that,
self-perform,
they could really reduce a little bit, but still be competitive in the market. So those are the ones still doing the deal. Maybe they're not doing like 10xing, right, or something, but still they're doing some
If you've got a
good
good
deals.
crew,
And also there
sure,
are a lot of good opportunities I see in the market right now, especially in DC. Compared
Especially in
to,
DC.
yeah, you see like
everywhere.
good deals, like you could really negotiate well. I think in DC has great potential, because you look at the rest of the world, anywhere in the world, a capital city,
It's
you look
true,
at the
man.
market, DC is the most affordable capital in the world.
Yes.
Still, yeah.
DC is the capital of the
I think I
United
was right
States of
here.
America, right?
I think
So-
I was right here, driving south on North Capitol, looking at the Capitol building with a newly arrived Frenchman, guy from France, who had been in commercial real estate, but moved to the States to marry a woman. And I was like, now what am I going to do? So he was, hello, we're here. So come on back. There's food in the kitchen. If you can call it the kitchen. And he said to me, this French dude, he's like, I can't believe. He's like, how this is about 10 years ago. So he's pointing at these buildings on North Cap. Like, what do you think that one's worth? Like, well, that one looks like it's in pretty good shape. Looks like a decent shop, maybe some apartments upstairs. I'm going to say 1, 2. How about that one? That one's kind of busted. I'm going to say 7. How about that one? That one's huge. I'm going to say 2. And he was like, I cannot believe these prices. This is a capital city, the capital city of the United States. He goes, Carlos,
Capital of the
are you
world,
kidding me?
could
He's
say,
like, I'm so excited to be here. I remember that conversation vividly. And I feel like that's a little bit what you were getting at when you're talking about the smart money liking Washington.
Yeah.
To talk a little bit more about,
It's comfortable. They know it.
but
It's safe.
look,
It's a safe
like
market.
whenever
But they're still going to charge.
whenever our confidence in real estate gets shaken as a society or, as an industry, I love watching how real estate performs, especially in the nation's capital. This cycle, what are you seeing in terms of, how people look at Washington? It sounds like you have opinions too, versus other places, or even categories. You could do things other than real estate. You could do real estate elsewhere. You could do real estate in the nation's capital.
Well, market rate or voucher or condo or what?
I like how
I mean,
you
just-
break it down.
Just generally the people's faith in the resiliency of this residential market. I don't want to talk about commercial. That's a whole other
For
interesting topic.
residential sales, resident market rate, or voucher?
Their
I'm seeing
belief,
different- I'm
their
seeing
belief in
different things
rents and
about-
their belief in rents going forward and resale value going forward.
Market rents.
Well, market, it's still as good as it's ever been for the right opportunity. Obviously there's a segment that really likes the voucher business, the value add business, but there's been a lot of
Tumult in the voucher side.
craziness with the agencies and DHCD and stuff. So that's causing
And the rates, right?
The
actual
rates
rates, yeah.
some areas they're going down, and some areas they're going through the roof.
Yeah.
So if you're able to get a fantastic building, what
20002.
west of 14th Street,
Yeah.
you're fantastic. So that part of the market is fantastic. Voucher. So the value add boutique west of 14th Street Market. It's fantastic for voucher. The southeast,
Yes.
the Anacostia, that's kind of problematic because of they keep messing around with it, the rates. But for market rate, depending on the area. So some of these tertiary, I see a lot of opportunity, like the Rhode Island, like this Rhode Island kind of Michigan Park to that whole little cluster is probably opportunity, but it's going to take a little longer because there's so many bad pre-foreclosure deals going for the bottom of Rhode Island, Home Depot, all the way up.
Is that right?
So that's going to be a great opportunity for, depending on what they do with rates, for voucher and market rate, because there's so many bad deals up there. So it's really like if you're getting a deal at 25 cents on a dollar, you're going to win anywhere it is, right? But there aren't really excellent opportunities in DuPont, Logan, Shaw. There's just no real inventory there. All the inventory, unfortunately, is in neighborhoods where they haven't turned. So they're not at the current asking prices. These deals aren't penciling for market rate, and they're not penciling for voucher because the first regime was a market rate regime. So now the plans and permits don't work because all the rooms have to be reworked to maximize for voucher. DHCD changes the numbers. So now what you thought you were going to get 6 months ago, a little less. Now you have to change the regime again. And people just give up. So that's why it's and all of that complications not being clearly conveyed to the sellers, because for me there's a small, for the ones we're not dealing with directly, there's that barrier with that commercial broker. So we can't get the seller the information. More importantly, their lender said, hey, I know you have this deal for plans of 50 unit plans and permits, but we cannot make this work with DHCD. We can't get the city to buy it. So that's the problems we were having on Kennedy Street. So we were going to sell to the city. Yeah, that didn't work. Now it's another group is trying to sell it as a market rate rental. It's 30 brand new units. They rent it maybe 3-4 months. Right? So it's really.
What are they asking for?
I don't know. Since you didn't
follow it.
So it's really kind of sub-market by sub-market. And also, if you're in that rental business, in the voucher business, you got to kind of be up on what council is going to do and what they're going to do with the rates in those different areas. That's because your lender's going to be on the air. So that's really kind of a complicated component to it as well, which is why there's so much opportunity, because no one's really the buyers aren't going to really kind of rework these deals over and over again to create a compelling argument to get the seller to take a 30% haircut. Right. No one's doing all that hard work. People right now are just asking for haircuts without the math and the data to support it. So that's why it's taking so long for these things to transact, because they all will eventually have a lot of like
But the
complicated
understanding hasn't worked its way through the system, all the players.
And DC hasn't helped. And now it's Department of Buildings, and now you have different, you have all these different requirements for voucher, and you have all these different regulations that they're implementing now. So it's going to take a longer, like the whole cycle is going to take a lot longer, which is just going to make the deal less valuable over time. So
did you guys have any comments or questions? Because I feel like I've been asking a lot.
Not specific questions, but maybe for sort of the voucher program, I think after the presentation.
So how does the voucher program work? In what regard?
For the family that receives a voucher, along the class, and here's a landlord, you rent for a voucher, and what's the risk involved?
As a landlord?
Yeah.
Well, it depends. I guess for single family versus a multi-unit, I'm not familiar with the condo or the apartment space, but for single family, the risk is the condition that they leave it. and how qualified they are. You can't qualify a voucher tenant. A voucher tenant is someone that has gone through the system and only makes median to low to moderate income. And there's a long, long list. And they only pay, for, 3-bedroom in Columbia Heights, you get 3,500. They might pay 200 of that.
And the program pays the
30%,
remainder
up to 30% of the cost, I think, correct?
as much as.
Right,
yeah,
as much as 30%.
How long?
So the program has now changed from guaranteed amounts. It's listed online, 3,500 without utilities. But now they're saying, well, we're going to challenge you, and you have to submit comparables.
Yeah.
And that's been the big monkey in the
It's
the
complicated. That's a separate business,
model.
complete different model. However, if you master it, and if you're buying the right deals,
Sure,
and-
yeah.
And the other thing I'm seeing, which is interesting, I'm getting a lot of calls from. This isn't. I'm primarily a Northwest listing agent. I'm not a Southeast. I'm not a voucher seller. But I'm seeing a lot of legacy owners who are now, or I guess they're hitting their rise in their 60s, 70s, and then I will sell their fully tenanted apartment buildings, 18 to 3 years, 12 years, 14, with people who've lived there generations of, 20, 30 years. So there's velocity.